before then of thinking that somehow banks were risk-free. And we treated them like that. So I think the big wake-up call for businesses is an acknowledgement that that supplier needs to be credit checked, needs to be risk profiled. And part of that, actually, I think, is that when you can anticipate rate rises or changes and so on, is requiring a business to be much more strategic about that supplier's, the relationship with that supplier. There shouldn't be a business in the UK today, if they've read the papers over the last few weeks about inflation and so on, who is not anticipating a rate rise in some way, shape or form over the foreseeable future, and should be starting to factor that into their thinking and their planning about where their business might be at the start of 2012 and beyond. So I think actually what the challenge is for businesses is not so much coping with whether it's 0.5% or 0.75% or whatever. It's actually looking out into the future and saying what might happen and what contingencies have I got in place to enable me to continue driving my business forward if this happens or that happens. So a series of scenario planning. That's actually a discipline which most smaller private businesses have not done in the UK. And they haven't done it because in the past they haven't had a need to do it because of this assumption about the solidity or the relationship with the bank. And I think actually, perversely, the credit crunch has done us a huge service in making businesses think more strategically about the supply of capital for their business.
If I could come to Phil next, what do you think such a rise, even if it is fairly minimal in the coming months, would have on members? There's a few commentators who believe that even that marginal rise might have a huge impact on smaller businesses and tip them over the edge. What's your perspective?
Well, again, it's taking the sort of demographic of our membership. We've got the two extremes really. We've got the ones that we know are very financially sound, probably net depositors, have very little, if any, lending requirement. And they would want to see sort of policies in place to make sure that inflation is kept under control and input costs are kept to a minimum. Clearly, we've got the other end of the spectrum, which is those that are heavily reliant on credit and debt, who will want to see interest rates kept as low as possible. My personal view is actually that a smallish, maybe up to 1% rise from the current 0.5 would probably have little effect in demand because there are other factors coming to play into that, some of them related to risk and viability issues. Yeah, that's about it really. I think there are clearly risks to some businesses, but Lucy's absolutely spot on. Good business owners should be managing those risks right now.
And if I could come to Karen next, if npower has any concerns about what these economic factors could have on your vast numbers of customers who you are looking at, and they're looking at risk of late payment, things like that, is it a concern at all?
Yeah, I think it is. I mean, we're finding at the moment that the customers are already, those that are struggling, is because they're telling us that their businesses are already slow because customers are not coming into the shops and buying from them. So I think an increase in the base rate will actually have more of an impact from our customers' perspective, and again from the credit side of it. If they're already not a good customer or not a great payer, then this won't help the situation. I think what we're trying to do is encourage customers to think more about, instead of just paying the bill when it comes in, is to pay it more over a monthly period, so sort of spread it out. And a lot more of our customers are actually asking for this now compared to 2 to 3 years ago.
Okay. And Paul, what's your perspective on any impact that you think it might have?
Sure. I think it's interesting that as the Governor of the Bank of England observed in his report, the cost of credit has become largely disjointed from the level of base rate, and it's LIBOR, or the cost of borrowing for the banks, is over and above a base rate, and whether or not I'm not going to say that a rise in base rate would have no impact on the price of borrowing, It certainly would, but at the larger level, it's certainly the cost to banks of borrowing money, which is impacting on lending at a larger level. But on the small business, a rise in base rate is obviously going to have an impact, because the smaller businessman will have his mortgage to pay, the price of his goods. Some of his business may well be financed from his personal credit card and his personal unsecured lending. So there was an important point raised earlier, as Lucy said, which is that the banks need to be aware, need to be factoring this into their business plans going forwards. And I think it's incumbent on all of us to make sure that our customers or our members, if we're a trade body, are aware of what the likely impacts are going to be and can prepare people in advance. There's talk now of November rate increase rather than where we were a couple of weeks ago, anticipating that would be in early 2012. The other point raised was about the changing regulation. I think the prudential changes in regulation, the new capital rules, liquidity rules, are already factored into the bank's books. I mean, we've been in some respects ahead of the game in terms of the requirements on banks around capital. We're very much aware of what's required going forwards, and I think the banks are already made the necessary adjustments to cope with that. On the conduct of business side, as Stephen mentioned, there are some risks there. Some of you may have seen the government's consultation on the transfer of credit regulation, consumer credit regulation, over to the Financial Conduct Authority. Somewhere in the midst of that consultation was a question about extending the remit of consumer credit regulation to larger businesses. And as Stephen said, if that was to be taken forward, that obviously has implications for the cost of going through the administrative process of lending to small businesses.
Okay, any more questions from the audience? We've got two at the front here.
Good morning. Joan Yeadon, Credit Control Consultancy. I'd like to hear the panel's views on the proposal that banks should be allowed to fail. And in particular, I'd like to know how the payment processing facilities that banks provide will be preserved, and also how businesses' deposits will be preserved as well, because not all businesses are living on borrowed money. Some of them actually do have cash in the bank. But I'd also like to hear everybody else on the panel's views as well. Thank you.
Okay, Stephen?
Absolutely. I mean, banks, like any other business, if they're really badly run, and if there's not to be an incentive for the organisation to take risks beyond what's sensible, need to have the ability to fail as institutions, and the management to bear the costs of doing that. But you're quite right. There are fundamental, wider social and economic interests in continuity of payment processes, security of deposits, and so on. And we all know what the consequences were or could have been. If the run on the Northern Rock, for instance, had just been allowed to carry on and extend to other firms. I mean, there are, of course, some deposit protection arrangements that apply to businesses as well as consumers, but admittedly at a relatively small level, really. Yeah, that might be 50,000 for the individual's personal account as well as for the business. But compared with the sort of size of balances that many firms have, that obviously doesn't make a huge difference. So we come down to a few things actually which need to be done to mitigate that. We need to make the risk of failure relatively lower, not impossible, but relatively lower, particularly for retail and universal banks that are supplying those essential services and so on, through better regulation, through higher capital levels, and through better practice, I suppose, through the industry. I think the second thing is the whole area of recovery and resolution schemes, as they're called, sometimes kind of termed as living wills, where we know exactly what's going to happen over that weekend that a bank has failed, such that things can be kind of managed either to rescue things and put it back into stability, or if not, then to move that on to another organisation or to help without that being at the cost to a taxpayer. And there's good progress being made on these living wills around that. And then the fourth kind of possibility that's been mooted by the Independent Commission on Banking is the idea of ring fencing retail and investment banking. So it shouldn't be possible for an individual institution, and then by extension on a global systemic basis, for a problem in so-called casino banking, if you like, to kind of affect the safer and more kind of important side of it. The idea there is to have more of, not a complete separation, but more independence between those different businesses. So it should be possible for the investment banking side of things effectively to fail without affecting the retail side of business. And I think if properly constructed, and you've got to be quite careful about how that's constructed so it doesn't overwhelmingly increase the costs of capital and liquidity and restrict the competition in the marketplace, that does have a role to play. We'd certainly support an element of ring fencing.
And Kevin?
Well, I think I'm with you, Joan, actually. I think I'm with you because I think you're right. I think it's not straightforward. I think we've got a population of sort of credit professionals in the room today, and I'm sure it's sort of going through you all personally to see any business that appears to have been to run in a way that sort of defies common sense, or just where decent business practices haven't been found, and for that business to be supported beyond what you would normally expect to see. And we talked about the example before about pre-packs. I think it's a similar issue, isn't it? It's about good businesses being allowed to trade and not suffer from bad business practices. But I think it is more complex with the banks, unfortunately. I think the role that they play within industry is different, and so it makes that issue, that question, a much more challenging one to answer. Look, from my role within the invoice finance industry, it's perhaps something that I'm not directly qualified to comment on. But I think that, certainly from a HSBC perspective, I think we sort of take comfort from the size of the bank, and we take comfort from the scale of the bank and the scale of the operations that the bank has globally, as providing a check and a balance. And I think just from the evidence of the last couple of years, that's helped us.
And Paul, if I could come to you next.
Yes, banks should be allowed to fail, absolutely. But as Stephen said, they shouldn't be in a position where they would fail going forwards, and that's certainly what the current work and regulatory changes around prudential requirements are leading us towards, hopefully. Stephen very comprehensively covered, I think, the work that's currently underway to make sure that there could be a relatively straightforward continuation of services should a bank fail. As I say, we shouldn't be in a situation where a bank could fail going forwards with more comprehensive coverage on the capital side, the potential for ring fencing the riskier part of the investment bank. The resolution work is continuing, and I know that there's an awful lot of time and resource and funds being put into creating such practices as the single customer view, which is the ability to work out exactly how much everyone has within the bank at any given point. So I think that